particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a tax cut for more than 2 million families in Georgia. We're cutting taxes for people by a tax credit. It's about time the very wealthy and corporations start paying their fair share. It's about time. As simple as that.
The President of the United States speaking at a rally in Georgia. From New York City this morning, good morning. Alongside Lisa Bramwitz, I'm Jonathan Ferro. Tom Keene back on Monday. Here's the price action. A little bite out of a weekly gain on the S&P 500. We're down 17 points and negative 0.4%. Yields are higher by almost a basis point on a 10-year. Yields have been creeping higher through the week so far. 164.37. Euro dollar just south of 121. 120.98. Keeping an eye on Amazon after delivering another $100 billion plus quarter. Yes, in revenue, first quarter revenue jumping 44%. That stock up by a little more than 2% in the pre-market. Lisa, we've got to talk about the reaction to another big plan down on Capitol Hill in Washington, D.C., out of this White House. And this is the Capitol Hill reaction so far from Senator Manchin. Just in a couple of lines, it's a lot of money, that makes you very uncomfortable. You just wonder where that's going.
$4 trillion now is a lot of money. 1.9 trillion, not so much. 2.3, we're starting to get to 4 trillion. Perhaps that's a lot of money. It does seem like there is a groundswell of consensus that there is a way for the Democrats to push something through by September. What it looks like, though, is a question mark, especially because the higher taxes would affect left-leaning states on the coasts more than any other, John, which is the Democratic constituency.
It's such a good point, such a good point. Let's bring in Emily Wilkins of Bloomberg Government down in D.C. Emily, that makes you feel very uncomfortable. Senator Manchin, who else is uncomfortable in the president's party?
In the president's party, there are a number of moderates and progressives who aren't really fully happy with what the president has put forward. Progressives are saying, where is healthcare? Where is our extension of Medicare? As Lisa just pointed out, that state and local cap, a lot of Democrats made it very clear that they want to get that removed. They want to get that out of there. But look, President Biden's proposal, it's going to go to Congress now. It's going to start getting tinkered by lawmakers. So there's definitely a lot of discussion about how they're going to put things in, what they're going to put in, what this actual bill is going to look like. I don't think we're going to see President Biden's bill not get changed here. I think we're going to see some pretty big revisions as it goes through Congress.
Lisa, Tom and I have spent the week talking to people in the bond market about what they expect, and they are really confused right now about what to expect. They don't know how to process any of these bills at the moment, what gets actually approved, what goes through, and what size it comes through at. Emily, do you have a timeline even for when you expect any of this stuff to happen?
So we're waiting for Congress to come back in mid-May. At that point, we're expecting to start seeing some of the text for some of these proposals, some of the House committees, transportation, infrastructure, to begin taking up pieces of these bills. House Speaker Nancy Pelosi has said that by July 4th, she wants Congress to have gone ahead, or rather the House to have gone ahead and passed that legislation. From there, it goes to the Senate. Remember, things get a little complex there because the Senate has those procedures and processes around budget reconciliation that prevent some things that Democrats might want from actually making it into a budget reconciliation bill.
Emily, I feel like a broken record because I ask this every day, but why is the emphasis not on just enforcing the tax rates that are currently in place versus getting tax rates higher?
I think this speaks to the larger feeling among the American people, the American voters. You know, this was a campaign promise that President Biden had. It was something that he talked about. I mean, these raises that we've seen in capital gains tax and in income tax, these were things that he proposed on the campaign trail. He might not have put an exact number on it, but we knew to a certain extent this was coming, and to a certain extent, voters voted this in. I think it's also an effort to try and say, look, we are trying to find a way to pay for these proposals that we are putting forward. And right now, I think a lot of Americans, the idea of taxing the wealthy and having the benefits go to the middle and lower income classes, it's a really appealing idea politically.
Emily, this goes to the confusion that John was just talking about in markets in terms of how to read this, because what you're talking about is coming through on campaign promises that may or may not see the light of day and may or may not have the support of Democratic colleagues. What's real in this? What do people that you speak with say could plausibly get passed by September?
I think that when you put forward a proposal like this one, you kind of expect to a certain extent that you're going to hit some sort of negotiation. And we've already seen individuals like the key moderate Democrat, Senator Joe Manchin, say, hey, Biden's proposed raising the corporate tax rate to 28%. I think that's too high. I think we need to raise it to 25%. And so there does seem to be some room for negotiations. I mean, you saw yesterday, Republican West Virginia Senator Shelley Moore Capito, West Virginia doing big things right now. But Senator Capito actually spoke with President Biden about the infrastructure part of the plan, that $2.25 trillion. And she said that she felt that discussions went really well and that there might be more room for Republicans to work with Biden on this particular proposal.
Yeah, a little bit of news around that in the last 24 hours, Emily. The Big Four leadership in the Senate and the House meeting the president in the White House at some point over the next week. Any kind of timeline for that, Emily, when you expect that to happen and what you expect to come from it?
So that'll happen soon after Congress's returns in mid-May. May 12th is when the Big Four are scheduled to meet. That is the Democratic and Republican leaders of both the House and the Senate. And it's notable because it's actually going to be the first meeting between President Biden and Republican House Leader Kevin McCarthy since President Biden became the president. And I think that sort of speaks to the relationship that Biden has between Republicans. I mean, it's interesting. He's met with a number of rank and file Republicans, but he has yet to meet with the leader of House Republicans. And I think maybe that this meeting signals a shift in really wanting to make sure this next package is a bipartisan one.
Emily, good to catch up. Down in D.C., Bloomberg's Emily Wilkins. Lisa, I keep asking the timeline question because so many people in this market are also grappling with that. If the Big Four aren't meeting with the president for another, say, 2-3 weeks, who knows? How much longer will it take to get this bill done compared to the previous one? And the answer to that is pretty simple at this point, a whole lot longer.
Yeah, although people are saying the Democrats are going to go it alone. Again, though, I do wonder how much of a consensus they have, especially as you've got those left-leaning states that are getting hit harder. Chuck Schumer, the likes of him, as well as his New Jersey and Massachusetts compatriots, probably pushing back on the salt cap tax, salt cap deduction, as well as a number of other issues. I don't know. I honestly, markets are basically shrugging this off. They're not pricing this in.
Here's a line that you might be interested in. This comes from Bank of America. It's just around the labour market improvement we've seen. There is a high risk the participation rate does not fully recover, leading to a quicker drop in the unemployment rate and faster wage growth. The reason I bring up this line from Bank of America this morning, Lisa, is because I wonder what the data looks like in the months to come. The longer it takes to come to an agreement down in Washington on the next big package, where we are in this economy and how quickly we might get there.
There's also an issue here where the jobs that are coming back in the new economy are higher skilled jobs, and some of the more rote jobs are being taken over by machines, by computers. So what do you do if people don't have those skills? They're dropping out of the workforce, and that anecdotally is what a number of economists are talking about. How do you deal with that workforce? How do you invest in trying to bring some people up? And this, honestly, is going to be the conversation over the next decade.
We're going to touch on that, not just over the next decade, but over the next 10 minutes. We'll do that with Jay Bryson, Wells Fargo chief economist. He'll be joining us shortly. From New York City this morning, great to be alongside Lisa. Tom Keene taking a long weekend. Equity futures shaping up as follows on the S&P 500. All-time highs at the close yesterday. Then we pull back. We're down 17 and off by 0.4%. Big tech this week, just absolutely knocking it out of the park. Alphabet, Apple, then Amazon joins the party. More still to come on that too. This is Bloomberg.
we're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, the party, makeup will bounce back.
From New York City, this is Bloomberg Surveillance. I think the news of the last 24 hours is no stock split over at Amazon. And I wish Tom was here so we could discuss it.
Rub it in.
No, actually, I was going to really eat this if they did it. I was going to really eat humble pie if they did it, and they didn't, so I'm not. Equity futures on the S&P 500 come in just a little bit. Weekly gain, we trimmed that by about 0.4% on the S&P. The NASDAQ, the numbers out of big tech this week have just been phenomenal. 40% plus revenue growth over at Amazon in the first quarter. As Lisa pointed out, it is another $100 billion plus quarter for Amazon. It's just amazing to see these numbers. So the big question that we're trying to ask, just looking at the price action this morning, does it validate current valuations or justify further gains? And most people responding that it justifies current valuations. That's been the response so far. And I think we need to add to that in the weeks and months to come, because some people are still bullish and looking for more of the same and think that people will capitulate on that view. But as we talked to Jeff Mortimer of Bank of America a little bit earlier this morning, in fact, BNY Mellon, as he pointed out, at the moment you can take the data, but sometimes it's how the market responds to the data where the priceless information is. And I think there's a lesson in that this week. Switch up the board and get to this story right here. Job openings in America. Just look at the recovery here. And I think you can take any data point in America right now, whether it's GDP, almost fully recovering. Just looking at some reads of the American economy right now, that's what's happened, a V-shaped recovery. And job openings in America are pretty much back to where we started before the pandemic. Bank of America asking an important question too. Can unemployment drop quicker than expected, and therefore can wages pick up quicker than expected? Think about that. What does it mean for inflation? What does it mean for the labor market? What does it mean for the bond market? So let's finish there. Switch up the board quickly. 2s, 10s, 30s. This is how we're shaping up. It's a weekly loss for treasuries again. Lisa, I know you talked about the outflows a little bit earlier this morning on Twitter, I think it was. We'll touch on that in just a moment. Yields through the week up 8 or 9 basis points on 10s. Right now up about a basis point, 164.19 on a 10-year. On a 30-year, 230.29. Just a pickup in yields, Lisa. It resumes this week.
Yeah, we're going to be getting that inflation data in about an hour, 2 hours rather. Really interesting to see what the bond market reaction will be to that. Meanwhile, John, as you're talking about big tech and some of these earnings and the disappointing response, at least according to some stock traders, you do have to wonder how much is a regulatory risk component. Apple today getting an EU complaint over app payment issues. Aoife White's been following all of that, Bloomberg legal reporter. What is this, Aoife? What is this complaint, and what are the potential consequences for Apple?
Well, the complaint is one we've heard before. Spotify is saying that it's not happy about how Apple imposes payment rules on how you get a subscription on the App Store. I mean, Apple used to take up to 30% of a fee. That's quite sizable for some app companies, and they see that money going into Apple's pocket, and they'd like to see it go into theirs. What's interesting about today is it's the first time we've seen a major regulator come out and say that it's got a problem here. This is preliminary. So there's an antitrust complaint here. We don't have a final decision yet, but it's certainly a big warning out there for Apple about what might come.
how much has the European Union really led the charge when it comes to big tech regulation, even in the United States?
They've definitely been out there first, particularly on antitrust. I mean, there was something like $9 billion in fines for Google. You could criticize them for maybe not really extracting change from those companies, which, as you know, are still making lots of money and are still very powerful. But that does seem to have triggered change in the US, and it's also triggered change in Europe, that they might need rules, some actual regulations. Since antitrust enforcement, it hasn't really gone out there and made the changes that they wanted.
Aoife White, it's a story that's not going away anytime soon, and we'll have to continue this conversation another time on Apple. We're expecting a news conference with the European Commission a little bit later this morning. That'll take place in about 27 minutes' time. Any worthy news headlines, we'll bring them to you on this programme. Got to talk about this labour market too. A red-hot labour market, white-hot labour market, maybe in the minds of some people, looking at the recovery in America right now. I'm pleased to say that Jay Bryson joins us, the Wells Fargo chief economist. Jay, I want to start with a line that Lisa and I were discussing moments ago, and it was from Bank of America, and it was the risk that the participation rate remains where it is, doesn't really improve too much, and that unemployment can drop quicker than expected, and wages can grow quicker than expected. Jay, what's your take on that debate at the moment?
So I would think there is a risk that, you know, the labor force participation rate may remain low, but I would expect it later on this year to pick back up. You know, as the economy fully recovers, as schools reopen. I mean, there's been millions of people who've been sitting out of the labor market to take care of children and things like that. So I think you will see that start to pick up. Now, are we going to go back to 63.5 where it was before the pandemic right away? No, that's not going to happen. But I think you see it grind up. But also keep in mind, you know, you're talking about wage increases. Before the pandemic, the unemployment rate was at a 50 or 60-year low of 3.5%. And we didn't really see any wage acceleration at that point. So even if the unemployment rate goes down to 4 or something like that, I'm not convinced you're actually going to see a huge amount of wage acceleration.
Can you compare this cycle to the previous cycle, Jay? And isn't that what Bank of America is really asking, whether something has changed in this downturn that keeps people out of the labor market?
So, you know, I think what we saw in the last recovery was it was a very, very slow recovery. And it took years for some people to get back into the labor market. This time it's different, right? This was a public health crisis that forced people out of the labor market. Their skills, at least at this point, have not atrophied significantly. And so, in theory, at least, they should be able to come back into the labor market quicker than what they did, you know, 10 years ago, as some of those folks sat out for years and years.
There's a big structural shift, though, Jay, and this is what a lot of people are looking at, especially on the heels of these big tech earnings that show the momentum just building. The jobs are in higher skilled areas, cloud computing, tech on a whole range of issues, all of these ways, even implementing logistics in factories that are more dependent on robots. How do you judge an economy where perhaps the average wages are going up, but it means a bigger proportion of the entire economy is left behind, a bigger proportion of the workforce is not engaged?
So let's start with that, you know, higher skill sort of thing. Okay, there are also more productivity in those sorts of jobs. So maybe wages are going up in those certain sectors, but they're more highly productive as well. And so that keeps a lid on labor costs. I would also take some issue with the fact that it's all in these high wage sorts of industries. Where are the places that have been really beaten up? I mean, it's leisure and hospitality, you know, hotels, things of that nature, which have been closed down because of the pandemic. And as restaurants go back to 100% capacity, as people start to travel and hotels start to pick back up, you'll start to see some of those wage gains or some of those increases, you know, there in those lower wage jobs as well.
There's a question about wage increases also on the heels of some of the benefits, the unemployment benefits and the pandemic support that was given by the government. Do you pay any credence to this idea that people are staying out of the workforce because they're earning more from government checks, and that when they re-engage with the workforce, they're going to demand more?
You know, maybe, but I think that's kind of on the margin, right? You know, okay, so right now you can get $400 extra a week, and that's going to go through September. Okay, now most people know that's going to go away. Okay, and so if they have the opportunity to get a job today that's going to last, in theory, for a long period of time, you know, are they going to not take that job or not? Some people are going to make that calculus and they're going to say, I'm not going to take the job. Okay, but I don't buy the argument that everyone's sitting out of the labor force just to collect $400 extra a week. I think that's a marginal sort of thing as it affects, wage gains and as it affects the overall economy.
Look at the numbers we're expecting in the next couple of weeks. I'm just looking at the payrolls report, Jay, for next month. I don't have the payrolls report right now, of course. I'm looking at the estimates. 1.5 million at the top end. Lisa, that's from Thomas Kosterg of Bank Pictet and C. There's this big grouping north of 1 million. The median estimate right now, Lisa, is 950,000. And do you know what the low is? Top end 1.5. The low is 700K. That is as low as it gets right now going into the next payrolls report. We're expecting some really big numbers in the months to come.
The issue to me is, again, how quickly does this pick up? I mean, is this basically peak? We've been talking about this all week, right? Is this peak growth? Is this peak acceleration? Or is this just the beginning, John? And are we going to see it continue through year end?
Well, I think it's likely to be peak growth. And I think it's obvious why it would be peak growth, because we've had a mandated recession and this reopening that generates a mechanical response. And earlier in the week, I compared it to a submerged beach ball held beneath the water. What do you think happens when you take your hand away? It explodes to the surface, and that's what's about to happen in this economy, Jay. And we keep coming back to this concept of peak growth, and I hear a lot of people using it to justify what's happening in the market. But it's obvious with the nature of the slowdown that peak growth in this cycle is going to come at the beginning of the cycle. Then we move on. Why is peak growth relevant, Jay?
Well, I think it's relevant for market pricing and things of that nature. Now, in terms of the overall economy, does a normal person, can they feel the difference between, say, 9% annualized growth, which we think we're going to get in the second quarter, or 6.4, which we got in the first quarter? No, they're not going to be able to feel that difference. So again, I think it matters in terms of pricing and financial markets, but in terms of the average Joe and Josephine out there, what they're looking at is the labor market. They're looking at the unemployment rate and how good that labor market is. And whether you're growing at 9% or whether you're growing at 6%, let's face it, the labor market, I think, is going to remain very strong for at least the next few quarters.
And these are the cumulative gains that I think matter just a little bit more in certain parts of the market too, Jay. It's great to catch up, as always. Jay Bryson there of Wells Fargo. I think at the moment, Lisa, this is such a big debate in the bond market too. What ultimately matters, is it the peak growth that we might experience in the next couple of months, or the cumulative gains that we're about to see over the next 12 months, which are going to drive the unemployment rate lower and potentially generate some price pressure too?
Well, to me, this is really the question, the wage increases that we see and how persistent they are. When do we start talking about, dare I say it, Tom, this is for you because I know you're watching at home, transitory versus more persistent? And it really does come back to the wages, how much they will increase, and not just on an average level, but in the same jobs in a real comparative way, John.
It's not about what the Fed should or shouldn't do, it's about what they will or won't do. I always go back to that line because we always embrace this conversation around what they should and should not do. Their interpretation of transitory ultimately defines what they will do next. Now, what happens further down the line if they make a policy error, that's a different conversation. But in the near term, they just believe, absent a tight labor market, any price pressure isn't persistent. I mean, we got that from the chairman this week, didn't we? That was basically the message. Any price pressure, absent a tight labor market, will not be persistent price pressure.
Right now, they have the luxury of doing that because, frankly, the markets are not pressing their hand. The markets are saying, we buy what you're saying, and frankly, you're right. So the second that markets start saying you're wrong, we think that you're making a policy error of not hiking or tightening policy, then they have a real problem and have to communicate this better and have to actually start talking about economic expectations. Right now, markets are saying, you're absolutely right. Jay Powell is sitting tight, and he's in a great place.
We don't see that in the bond market, do we? No pushback right now, certainly not the front end. This is way too serious, I have to say.
I know. Well, I mean, no one's drinking.
We had a serious conversation for 41 minutes. No one's drinking, isn't that true?
We'll talk
isn't
about,
that true?
We'll talk about the tots
Nobody is consuming alcohol on this program. Maybe that's what's missing.
Newsflash.
Coming up, Andy Pekos, Johns Hopkins Bloomberg School of Public Health professor and virologist. Equity futures down 21, we're down 0.5%. Yields unchanged on a 10-year, higher on the week, unchanged on a session, 163.83. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The euro area economy slid into a double-dip recession at the start of the year. Strict coronavirus lockdowns kept businesses closed and consumers were reluctant to spend. Output in the 19-nation euro area was down 0.6% in the first quarter. It fell nearly 3 times that rate in Germany. Meanwhile, the US posted annualized growth of 6.4%. In Florida, Republicans in the legislature have voted to impose a number of restrictions on voting. That adds to the national push by Republican lawmakers to make it more difficult to vote. Florida's been a crucial battleground state. Donald Trump won the state by more than 3 percentage points back in November. Rudy Giuliani says that federal investigators seized material from his iCloud while he was representing Donald Trump during his impeachment. Giuliani spoke to Fox News the day after the FBI raided his Manhattan home and office. The Justice Department isn't commenting on Giuliani's claims. Prosecutors have been investigating Giuliani in connection with his lobbying work in Ukraine. And China is cracking down on tech companies that are expanding in finance. Regulators have imposed wide-ranging restrictions on the finance arms of 13 companies, including Tencent and ByteDance. They're using many of the same limits that were slapped on Jack Ma's Ant Group. And Amazon expects a surge in online shopping during the pandemic to continue, even as consumers resume normal lives. In the last year, Amazon hired hundreds of thousands of workers and continued to open warehouses at a rate of 1 every 24 hours. First quarter results show that paid off. Revenue jumped 44% and earnings set a record. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America.
There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
we are getting calls from governments all around the world between people needing more vaccines right now, but also, more importantly, people thinking ahead of 2022. I worry deeply about new variants, but also variants emerging as the virus keeps evolving. And I think we're not out of this. This is why we decided to invest more for next year.
That was Stefan Bansal, the Moderna CEO from New York City this morning. Good morning. Alongside Lisa Bramwitz, I'm Jonathan Ferro. Tom Keene is on vacation on a long weekend. So here's a special edition of a market check for you with me. And Tom Keene in my ear somewhere saying, go to cash, nobody cares. Yields unchanged, 163.83. Let's just give it up. Euro dollar 120.83. In the equity market, 41.79. We pulled back from all-time highs on the S&P 500, down 24 points and off by about 0.6%. It's been a decent week of gains. It's been okay. It's been a fantastic month of gains. The biggest monthly gain on the S&P 500, going back to the boom times in November off the back of those vaccine headlines and the progress we were making on vaccinations in the months after that. But Lisa, to see the price action on Apple yesterday, I think got everybody's attention. Blowout numbers in Cupertino, California, and then red to end the day. What was that about?
Maybe they're listening to Tom Keene saying, go to cash. They're saying, you know what, go ahead. But basically, it's as good as it gets. That is the fear and the question. I frankly can't explain it away. I don't know, except to say perhaps this had been priced in. But what had been priced in? A $90 billion share buyback?
Yeah, 6 months ago, because this stock has hardly done anything in the last 6 months either. And it's not just Apple, it's others too.
And honestly, I will say going forward, there is a question of whether these companies will be left behind or whether they really have already been priced in some of their dynamism when their beats are off of comps during the pandemic when they were benefiting, John. Yep. They were not declining. Their comps are not that easy compared to other more consumer-facing companies.
There is some good news out there. There's a lot of good news out there in America. We're making some progress. New York City talking about fully reopening in early July. The president coming out early this week with some really incremental guidance on what you can do if you've been vaccinated. Let's bring in Andrew Pekos now, Johns Hopkins Bloomberg School of Public Health professor and virologist. I want to be careful with my words here, Professor, so let me choose them carefully. Do you think the current guidance for vaccinated people is a reflection of what the science tells us vaccinated people can do, or is it born out of ensuring compliance from the people who have still not been vaccinated?
Well, it's certainly based on the science in terms of what we know vaccination will do for an individual. You know, we now know, based on a number of studies, that vaccination will not only protect from severe disease, it'll protect from symptomatic disease, and will even reduce transmission. So getting vaccinated is going to now have a major impact on the pandemic. We assumed it would, and now we have the data to support that. So these relaxations of the guidance of the public health restrictions for vaccinated individuals reflect the fact that if you get vaccinated, you pose less of a threat to the rest of the population in terms of passing this disease on to people. So I think that's a good thing that you're seeing.
Andy, I think some people are still struggling with the logic of certain requirements of them, though. So let me give you an example of it. You go into a restaurant right now in New York City, you can sit down with your friends, take your mask off and have a meal. But if you dare stand up and walk to the restroom, you better put that mask back on. Now, Andy, I say that in a flippant fashion. You'll forgive me, I'm sure. But that's how people feel right now. They've been vaccinated. They go into a restaurant, they sit down, they take off their mask, they eat, and then they walk to the restroom and have to put the mask back on. What is that about?
Well, partially it's to also think about the other groups that you're not interacting with. As a vaccinated individual at this point in time, you really should be paying attention to the groups that you're interacting with. We're not giving people a free rein to just go out and socialize with anyone and everyone. We still have to be careful in terms of who you're interacting with, because we want the rest of the population to also reach this level of immunity so that we can have further blockades in terms of the ability of the virus to transmit. We don't want to rely on one individual and their immunity to protect the entire community. We need other people to get involved in this. And so while vaccination reduces the risks of transmission tremendously, it doesn't eliminate it. So until we get to a level where most of the people are vaccinated, it's still good to have some of these reminders that we're not out of the woods yet. We still have to be careful and measured in terms of how we're approaching this pandemic.
Andy, are public health officials at odds in some ways with the elected officials that are trying to get their economies going quicker? I mean, the idea here that you have the likes, while you've got the CDC that still won't give guidance saying that you can go and be part of a bigger group if you've been vaccinated.
Absolutely. These are going to be conflicting goals in some perspective. I think there's no public health individual that wants to see the economy continue to be shut down. All public health individuals, have families, have lives. They want to get back to some semblance of normalcy. It's just simply a question of the rate at which we do this. It's a reminder when you look at the case numbers that they're falling, but they're still at a very high level. And with vaccination rates slowing down across the U.S. in particular, we are a little bit worried that we're going to hit some sort of plateau of vaccinated individuals that's much lower than what we need to really make a major impact on the spread of this virus. And I think that's the real area where we're conflicted in. How do we keep pushing to get the immunity up in the population? Because that will eventually allow us to open up in a much more safer way.
Andy, how effective are vaccine passports? Some people have complained that perhaps they're not that effective because we don't know how long the vaccine will remain effective for. So if it's 6 months, they won't be applicable after that. Other people saying it's just a political issue that they're not being implemented currently.
Well, I'll leave the politics aside, but if you speak from the science, a vaccine passport that has an accurate date in which you've gotten your initial vaccination and your booster will actually is a relatively good way to keep track of your immunity. We'll know over time how long that immunity goes. So if you have documentation of when you got vaccinated, you can be put on that scale of how relatively protected you are. So scientifically, there are ways that you can capture this information to be accurate. Obviously, politically, it's a whole other issue in terms of whether or not people want to go to that extreme and for what things they want to have a vaccine passport to allow them to take part in those.
Andy, always great to catch up with you. Good to see you. Good to hear from you. Andrew Pekos there, Johns Hopkins Bloomberg School of Public Health professor and virologist. Isn't that always the ultimate question, ethically speaking, Lisa? Do you have to give up some freedom to gain a whole lot more freedom? Isn't that the conversation right now around vaccine passports?
That's been the question for the 14 months that the pandemic has been raging, and that's when people were talking about China and how they cracked down and definitely restrained human rights by any democratic standard, and yet had a more effective way of stopping the pandemic more quickly. And then in the U.S., people saying, don't restrain my freedom, and yet whose freedom are we talking about if this is a societal problem and a societal need to combat it?
Yeah, and I do think from that perspective, Lisa, I don't think we should just completely dismiss those concerns. Once you give up certain freedoms to the government, it's very difficult to reclaim them. And I think many people are grappling with that after what's happened in the last 12 months. There are some power-hungry individuals in government. There always are. Let's not pretend there's not. Once you give some of that up, it's hard to get it back.
Well, Tom is trying to get it back today.
Tom is getting it back.
And he's really
Tom's having
having
a long
great
weekend.
time. Yeah, he was hoping to celebrate the
time,
Amazon stock split.
He didn't get that, did he?
He was going to call in, though.
Do you know what, Lisa? I'm telling you, honestly, I went through that press release, and the first thing I looked for was the first thing I looked for.
Me too.
I was like, thank goodness for that. I don't have to put up with a day of that. Equity futures down 25. We're off 0.6%. All-time highs. We pull back.
If you can just scan all the incoming mail, all the incoming luggages, it's going to be a massive time saver. And it means that we can capture a lot more of the illegal wildlife trade that's currently going undetected.
So our focus is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
The Fed's got to be a lot clearer both on the inflation side and the real side. And fiscal policy has to confront the fact that we do have to pay for things.
As inventories are restored over the course of this year, it's just going to add further oomph to this economy.
We understood COVID was easing. We understood people were going back in, and that started getting priced into the market. Now we're delivering the earnings to justify that.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change?
Where does this thing peak out? I have no clue. The companies don't have a clue.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Pulling back from all-time highs from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene back on Monday. Equity futures down 0.6% on the S&P 500. It has been a blowout week of earnings for the big tech players, Lisa. The numbers just phenomenal.
Which is a reason why, again, our discussion has been price to perfection. Is that what we're seeing with respect to the response? I like this idea that perhaps you learn more from the stock reaction to some of these earnings than the earnings themselves, as it's basically been a shrug to beats that have absolutely blown expectations out of the water, John.
And the numbers and reaction have been mixed. But within the numbers, the performance of the earnings has also been mixed. And I find that interesting. I made some notes on this. Pull forward and payback. Where did we see that? Arguably saw a bit of that in Netflix. Definitely saw that in Pinterest. Booming ad spend. Saw that in Alphabet. Saw that in Amazon. Did not see that in Twitter. Higher costs, 3M. Seen a lot of companies talk about higher costs. But this week, I think, Lisa, the standout story outside of big tech has been execution risk. Caterpillar, Ford, big companies that have got that embedded cyclical story but will struggle to meet demand because of a chip shortage. And that's got to be a question we ask a little bit more. Yes, we will see a big year. Which companies can meet that demand?
And also, which companies are going to be disproportionately affected by the chip shortage that don't necessarily have the leverage that the likes of Apple have? The idea here that you get not as much specific chip supply for a Ford, say, they don't have the clout with the chip suppliers out of Taiwan as Apple, which demands such a big component of this. This is what Pierre was talking about yesterday.
Apple negative yesterday and down again this morning, off by 0.9%. Unbelievable after seeing the numbers they put up for the last quarter. Look at the market right now. Equity futures shaping up as follows. Here's a flavor, a taste of what's happening this Friday morning. We are down a little bit. We're off by 25 on the S&P 500 and negative 0.6%, 41.78 on the S&P 500. Yields unchanged. We settled down at 163.83, 163.65 right now. Euro dollar 120.84, slightly negative, down by about 1/3%. Lisa, great growth in America yesterday and negative print for Europe for first quarter GDP. That story very well known.
Yeah, the consensus in the past couple of weeks that Europe might be the source of positive surprises getting a little bit turned on its head over the past couple of days as the dynamism of the U.S. continues. If Todd were here, he would make fun of me for having barrels of oil in my living room when it was trading at negative levels. It has surged since then. It's down today, but up dramatically. And so too have the big oil companies absolutely surged. Exxon shares up 45% year to date. It is poised to report earnings in about a half an hour. Chevron just reporting earnings. Shares down a little bit in pre-market trading, but they beat expectations and showed the key aspect for big oil, which is financial discipline. They're paying down debt. They're expanding their dividends. They're expanding share buybacks. This will increase the conversation about stocks acting like bonds, paying out bigger coupons in some capacities than you can get in the corporate debt space or in the Treasury market. Then at 8:30 a.m., we'll get possibly more evidence of U.S. exceptionalism, the idea of core PCE, a measure of inflation that the Fed looks at in order to determine whether or not to raise rates or tighten policy. Also, income and also spending figures out of the United States. Expect blowout numbers on the income front as well as spending. 20% increase in income on the heels of some of those checks that went out in March. And tomorrow, Berkshire Hathaway is reporting at its shareholder meeting, its annual meeting. They're going to be talking about their cash pile. And also Warren Buffett, perhaps discussing a little bit more about what he did with airlines. Not so great. You were talking about this earlier in the show, John, and I found this interesting because he didn't get it right. He really didn't get it right.
Yeah, and I think sometimes you have to turn to the smartest people to ask them the lessons they learn in a downturn, some of the mistakes they might have made as well, because I think a lot of people made a lot of mistakes. I've said repeatedly that the last 12 months has humbled so many people, and you've got to kind of retain that humility going through the next 12 months too, because there is so much unknown right now for the 12 months ahead of us. Lisa and I had a nice back and forth on the credit market yesterday and how things were stacked up in credit's favor. Default risk through the year ahead, expected defaults, that's been trending nicely lower. We've seen a lot of refinancing of this market. That gets better. Upgrading some of these names. There is real upside to upgrade risk in the year ahead too. But Lisa, what you touched on, I think has got to be the most important element as well. It is valuations and where our valuations are right now. Bank of America asked in their European credit survey what they were most worried about right now. And do you know what the answer was? And it knocked COVID-19 off the top spot. It was just lofty asset prices. That was basically it. Lofty asset prices. And that went from 10% in the previous survey to 19% this time around. And there's always that cliche line that the only thing to be bearish about is that there's nothing to be bearish about. And that seems to be kind of the story in credit right now, is that the one thing to be bearish about is the fact that so many people aren't bearish at all. And valuations are where they are, Lisa.
Riddle me this. Companies have a record stockpile of cash on their balance sheets, and they're selling hundreds of billions of dollars of debt, long-dated debt. These are investment-grade companies. Why are they raising more money if they have so much cash that they can't even use? It's because they can, because they think they're getting a good deal. And that does mean perhaps the bond investors are not getting that great of a deal,
I mentioned this number yesterday, 70%, more than 70% of issuance year-to-date in high yield. Refinancing, that speaks to what Lisa's talking about. At the longer end, lower interest rates, and that just adds to this bullish story in the credit market right now. It's been a phenomenal 3-4 months. First 3-4 months of the year so far. I want to bring in Chris Morangi, Gabelli Fund's Co-Chief Investment Officer. Chris, always good to catch up, sir. In many ways, it's the boom we all expected. It's the boom we all agree will continue for a number of months, maybe a number of quarters as well. Chris, the theme that we all teased out of earnings so far this week has just been execution risk. I know you're focused on it too. It's just a simple question, whether these companies can execute, whether supply can meet demand. Any signs of success, any signs of failure? Do you see them in different places?
Yeah, so I think you hit the nail on the head earlier when you suggested that the thing to be bearish about is the fact that there aren't enough people who are bearish. And we think about the risks out there. And in my book, the biggest risks are what I define as supply chain issues broadly. That includes getting goods on and off ships. It includes higher copper, oil, wheat prices. And of course includes chip shortages, which we're seeing across a wide variety of companies, everything from SiriusXM and their radios to Caterpillar, as you mentioned, that really, silicon is the new oil and it's everywhere. And no amount of money can alleviate that shortage. So like inflation, that may be transitory, but we're talking quarters, if not years, and not just a one-quarter issue. So that's something that curbs our enthusiasm a little bit, higher price levels, and just an inability to meet consumer demand.
Chris, easy for me to just sort of pick on a sector and say the autos, this will affect all of the autos. They'll all suffer with this. Do you see signs that some companies are actually navigating this better than others so far?
it's a little early. It's a little hard to tell. Obviously, we'll see that the good management teams are going to be able to source chips and do a better job than others. But we haven't quite seen that play out just yet.
So, Chris, are you avoiding autos because of some of the chip shortages?
No, I mean, we like a lot of the auto parts companies. Obviously, forecasts are going to be impacted by those shortages, but the demand is there. There's a lot of obviously pent-up demand across the consumer sector, and autos is one of them. And if the auto companies can price their way to better earnings, they're going to do it. They have the opportunity to do it.
Zooming out, Chris, we were just talking about the response to these earnings, particularly from big tech, and the response basically being a shoulder shrug. It was priced in. Do you think that this is a sign of caution, or do you think that this is a sign to buy, that perhaps there is enough caution to think that that risk of too much euphoria isn't there?
Yeah, it's a good question. The only real surprise for me this earnings season so far is the magnitude of the beats, as John mentioned earlier. In Amazon and Google and Apple. I think the question is this as good as it gets? They're still in many ways benefiting from quarantine. COVID is not over, wasn't over in the first quarter. But interestingly, they don't get the benefit of the base effects that a lot of other companies do who had, significantly down first, second, third quarters. So I think the focus for earnings for stocks will continue to shift from the mega cap names to many of the more cyclical value names.
Chris, before we let you run, on a lighter note, we haven't caught up since what we saw play out in Europe on the European football front. You like sports teams. You mentioned that in our last conversation with Lisa and I, and you were talking about getting exposure to that theme. Were there any takeaways from that dramatic incident of the last couple of weeks for European soccer?
Yeah, I think it just indicates how tribal sports fandom can be and how durable it is. And that's one of the reasons that we love the sports industry. And, you can get exposure in the U.S. by owning Madison Square Garden Sports, the Knicks and the Rangers, who are doing quite well, and Liberty Braves, who are at the top of the standings. They've got some work to do, but we think there's a monetization coming there over the next couple of years.
And we won't talk about the Yankees. I promise you that, Chris. We won't do that. Tom's not here, so we don't have to. Chris Maranghi, it's good to catch up, Chris. Gabelli Fund's co-chief investment officer. Lisa, I'm about to get a lot of hate mail because I accidentally said the S word.
Yeah.
Soccer. I don't know where it came from, to be honest with you. Well, forgive me.
Do you actually feel yourself cringe a little bit when you say
when
soccer?
I said it, yeah, just a little bit. Just a tiny bit. I'm not, I'm not consumed by it. I just found it a little bit.
Okay, so what's your takeaway from the whole debacle over with respect to the Premier League?
Bottom line, not just the Premier League, for La Liga in Spain, Serie A in Italy, this isn't over. Bottom line, this is not over. Barcelona and Real Madrid, they're still trying to figure this out. Some of the big Italian clubs, Juventus, AC Milan, they're still trying to figure this out. The problems that led to this incident have not gone anywhere, and this whole story is nowhere near finished. It might be for some of the Premier League football clubs, but I don't think it is for European football more broadly.
When you talk about those clubs, are you talking about billionaire owners, in particular from the United States, that are looking to monetize some of these teams? Or are you talking about the actual fans that are looking to push back even further to bring this to a little bit more of a pure place?
So your first point, yes. Your second point, I don't know. I'd add a third point.
Okay.
I think for some of the domestically owned clubs, like Juventus, the Agnelli family, like Real Madrid, owned by Florentino Perez, led by him, I don't think that story's over for them. I think the way they see football as a spectacle where they have the best players at the best teams and the best teams all play each other and they can generate the most money from doing that, I think they want to consolidate that even further, and I'm just not in a place right now where I think that that effort is finished. I think it's far from done. Far from done.
Tom's researching it today.
I'm sure he is. I've got no idea. I've got no idea what TK's doing. I saw him post a picture of a drink last night.
That's what he's doing.
Yeah, an alcoholic beverage, so I imagine that's continued this morning too. Lisa Abramovich, Jonathan Ferro, Tom Keene back with us on Monday. Your equity market pulling back from all-time highs. We're set to get a warmer weekend in New York City. Tomorrow is set to be a good one. Ignore the clouds. It gets better from here, I hope. We're down 23 on the S&P 500, off by 0.6%. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. By September or October, President Biden is likely to see some version of his $4 trillion economic plan passed in Congress. The president has two major tasks. He has to keep various Democratic factions from splintering the party, and he has to keep fending off Republican attempts to portray the plan as radical. Democrats can use Senate rules to bypass Republican opposition to most of the plan. The euro area economy slid into a double-dip recession at the start of the year. Strict coronavirus lockdowns kept businesses closed and consumers were reluctant to spend. Output in the 19-nation euro area was down 0.6% in the first quarter. It fell nearly 3 times that rate in Germany. Meanwhile, the US posted annualized growth of 6.4%. In Israel, a stampede at a Jewish religious festival early today killed at least 44 people and left 150 hospitalized. It's one of the deadliest civilian disasters in Israel's history. The crowd was estimated at 100,000 people, mostly ultra-Orthodox Jews. And Apple is being formally warned by the European Union that its app payment system and marketing rules may violate antitrust regulations. Commissioner Vestager is speaking about the issue right now. The EU is escalating an investigation that could lead to big fines. 4 years ago, the bloc ordered Apple to pay billions in back taxes. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I think it was probably the most consequential first address to Congress by a president since Ronald Reagan declared a redirection of the country in 1981.
Yes, that was Larry Summers, the former Treasury Secretary, and you can catch the full interview tonight on Wall Street Week. Lisa, almost in shock, saying something. Was that something nice about the administration?
Yeah, he was actually one of the biggest opponents. I keep thinking about that article that he wrote, in the Washington Post, where he was basically saying this is terrible and unuseful, non-useful, and potentially detrimental to the economy. Could potentially foist inflation upon the economy that would be harmful. Now he's saying maybe it's not so bad.
You know, I have to say the former Treasury Secretary, for some people at least, can be quite a polarizing figure. Lisa, that one publication, that one issue, that one essay, that one piece sparked a massive debate. So whatever you think about the former Treasury Secretary, that is some impact to write one piece and have the impact that it did.
It highlights how inflation has become such a politically polarizing issue right now. You have some people, the Democrats, and particularly Biden's camp, saying, look, we haven't gotten inflation for years. We need to spend a lot more. We can do deficit spending. And then you have Republicans saying this time could be different. And really, people are looking at different data points to justify their view, John.
I want to turn to the data right now, the price action on the S&P 500 this Friday morning. Good morning to you all. Alongside Lisa Brambitz, I'm Jonathan Ferro. Tom Keane back with us on Monday. Your equity market down 24 on the S&P. We're negative 0.6%. In the FX market, euro dollar 120.85. Q1 rough for Europe, good for America. Does that story start to converge in the months to come with Europe getting better? Euro dollar 120.85. And Lisa, story of the week in the market. It's not just been a gain in equities over the last month. On the week, Treasury yields just starting to break out again.
The idea here that perhaps they got a little bit overbought last week. It seems like people are kind of moving back to this idea that yields perhaps were too low. I don't see, though, this massive sell-off leading to yields rising and this sort of consensus that yields are going to spike from here, John. Do you?
I've got no idea until we really understand what is happening down in Washington. And right now, there's no real consensus on that. What comes next? How big is that bill and what can get approved? Let's turn to Mario Parker on that, Bloomberg White House reporter joining us down in D.C. Mario, the president's got to keep his party together. Can he?
Yes, that's the tough lift here for President Biden. Not only is he facing Republican opposition, right? Republicans are staunchly opposed to any type of tax increases, but he also has to keep his party in line. Moderate Democrats like Joe Manchin, Kristen Sinema, Mark Kelly, they're going to have pressure on them as Republicans continue to try to attack both the president and then attack them with the midterm elections coming up.
Mario,
so
you live and breathe it.
He really has to convince his party to stick with them and stay in the fold with them.
Rock and a hard place. The rock being the progressives who want more, the moderates who want less, or at least they want the composition shifted somewhat. Who's going to win out there, Mario? Who's got the louder voice?
And that's one of the problems or the challenges facing President Biden. He's gotten relatively high marks from his party so far. He's on, I think, day 102 now. But he has had some disappointments from the left flank. The $15 an hour minimum wage, if you recall that debate a couple of months back. Student loan forgiveness as well. So he's facing some pressure from the leftward flank of his party. Whether or not the left wins out, is still to be seen. The package in his infrastructure package and his family plan does have a lot of the social safety nets, though, that the left has been calling for.
Mario, we keep talking about this $4 trillion of spending as sort of a monolith, basically that it will be a fire hose into the economy. When you talk to bipartisan individuals, think tanks, what's their evaluation of the efficiency of this plan and how the money is spent and how there are levies that are given to companies and wealthier individuals?
Yeah, well, one of the things that the Biden administration even touts is that people are by and large in favor of what he wants to do in terms of infrastructure, broadband, redoing some of the roads, the bridges, some of the energy initiatives. The problem comes in with how to pay for it. That's where you see the disconnect. The Biden administration is saying that outside of the Washington, D.C. zip code, there is bipartisan support for the bill. But then once you get here into Washington, when you get to the think tanks, where you see some of the discrepancy is, how to pay for it. That's where you see some of the differences.
All right, but Mario, putting aside how to pay for it, outside of the Beltway, there are people wondering, is this efficient uses of the spending, right? I mean, in other words, will the money that is put out there actually have a real generative effect for the economy? What do experts tell you on that front? And is there anyone actually trying to evaluate that?
Yeah, there are. Experts are saying that it will have a bump on the economy. Of course, as you and John alluded to earlier, there's the question of whether or not it could cause inflation or lead to inflation. So far, the consensus has been that it may not. That's to be seen. But so far, I mean, from what we understand, there is no doubt that it will have some type of impact on the economy. And he gets high marks for that. And the White House has been touting that part of the bill.
Mario, how important is the Big Four in the White House in a couple of weeks' time?
They'll be at the White House really soon, which is a very large signal, right, that President Biden sees the importance of having them at the table. One thing that's always fascinating and helped President Biden then candidate Biden become President Biden is the fact that he's been in Washington for 4 decades, right? So he knows how these things work. He knows how to get, the leaders of both parties into the Oval Office and the symbolism to that, and both what that means for negotiations.
Mario, good to catch up. Good to see you. Come back soon. Mario Parker, Bloomberg White House reporter. Lisa, is it significant? Because we saw the Republican senators being brought into the White House early on in the conversation around the relief package, and ultimately bipartisan talks went nowhere. You invite the Big Four. How important is that as a shift, as an outreach?
Maybe from a PR standpoint, I don't really see moves based on the people that we speak to. And obviously, I have no inside knowledge of the negotiations going on in Washington, D.C., though. There does seem like this is a go-it-alone type of approach. The idea here that they're trying to get something by September, and very much the Democrats are leading the effort. But I don't feel a consensus. I really don't, with Joe Manchin, with Chuck Schumer, with the sort of disparities between the more liberal wing of the Democratic Party and the more centrist. I don't see it.
Never mind uniting the country or uniting Congress. You've got to unite the party. We talked about that rock and a hard place. The progressives want more. The moderates want less. Who do you please? Who do you disappoint? Look, in any negotiation, I always think that everybody should be somewhat disappointed. In a good negotiation, you have to give up something. Who gives up what in this party right now?
It also shows, frankly, how much the Democratic and Republican parties are shifting, because Trump Republicans actually like a lot of aspects of these plans, right? I mean, they're not the ones that are going to be taxed that much higher, a lot of them on average. And some of these issues actually are appealing to a working class sort of blue collar group, whereas on the Democratic side, it actually tends to be wealthier, which is where you see in some of the states.
Yep, in the blue states, here in New York, in California too. Let's turn to the price action to round things up for you. Equities doing okay. We're down 25 on the S&P. On a week, we're doing okay. On a month, we're doing even better. We pull back from all-time highs and down by 0.6%. Yields 164 on 10s. Euro dollar 120.88 on the FX market. Mark McCormick of TD Securities, global head of FX strategy, joining us on the other side. From New York City this morning, good morning. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day. This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio. And I get to take a deep breath. Tom's not here, so this next couple of minutes won't be interrupted. Let's take it on. Futures off by 23 on the S&P 500. We're off by about 0.6%. On the Nasdaq, down by about 0.75%. This has been such an interesting week for earnings. Just three different themes that I think Lisa, me, Tom have been looking at through the week so far. Execution risks, Ford, Caterpillar. Basic question, can supply meet demand? Then you've got the payback for pull forward. Katie Lyons talked about Pinterest earlier this week. Throw in Netflix maybe into the mix as well. And then maybe the underappreciated story elsewhere has been this embedded cyclical story within big tech. The ad spend at Amazon, Facebook, and the ad spend at Alphabet, where they just knocked it out of the park. And the stock market's picked up on those stories because Alphabet has been flying year to date, and it added some weight to that move. Switch up the board and get to this. I want to run through things just quickly for you. We'll roll through the data boards. In the 10-year right now, up by about 5 days, over the last 5 days, up by about 8 basis points to 164.19. We've had several weeks of gains for treasuries, yields lower. Then we started to see the move go the other way. Yields start to break out. We'll have some data through the next couple of weeks that could be explosive, going into that 164.19. And when I say explosive, let me put some numbers on it. We could have a jobs print north of 1 million, 1.25 at Morgan Stanley. Thomas Kosterg looking for something like maybe 1.5 million. Get your head around these numbers. They're the kind of numbers we'll have to think about in the weeks to come. Let's finish on this. Switch up the board just quickly. I'll run you through euro dollar. Euro dollar 120.88. First quarter, great performance in the American economy. Terrible performance in Europe, contraction in Europe, boom in America, a story that's well known. We were testing 116, 117, we snapped back because we're starting to talk about convergence just a little bit more. Euro dollar 120.88, negative on the session. We need to see some better data from Europe now that backs up the vaccine progress. That was good, wasn't it, Lisa?
I'm sitting here, I'm laughing. I'm thinking,
just waiting.
What would Tom say?
I've got no idea. What would Tom say?
How is Capri?
He would say
You're
yes.
You're going to go to Capri?
Yes, yes. Something like that. Should I
no
do
one's
it, Tom?
interested.
Something like that. I'm going to get in trouble.
That was awesome.
Kaylee, you run us through the stocks this morning, please.
All right, now I need to pull it together, John, but let's talk about first the explosive growth at Amazon. I feel like I might be personally responsible for this because all throughout the pandemic, I've been getting at least 3 Amazon packages a week, and it seems everybody else is too. That drove a record quarterly profit for the company, revenue up 44%. And the thing about it is the outlook also very strong. The company does not think this pandemic online shopping behavior is ending anytime soon. That stock is higher by more than 2% in pre-market trading. But John, talking about the advertising boom that you were just speaking to, Facebook and Google, the thing is Twitter is not benefiting from that in the same way. It only had revenue growth of 28%. in the quarter just reported that met expectations, but is much smaller than the growth seen for some of those other advertising competitors. And the outlook also missed, so that stock is down by 12.5% nearly in pre-market trading. Now, Western Digital is higher. It beat on the current quarter. It beat on the outlook. It is benefiting from demand for those NAND memory chips. And then Texas Roadhouse, this is an interesting one. Apparently people are very hungry for steak and ribs as the economy reopens. They're going to that restaurant chain. It beat on the outlook and is higher by about 3%. But we have to talk about one of the other themes you mentioned, John, and that is the supply shortage, specifically in semiconductors. We have Cirrus Logic moving to the downside by nearly 12%. Its outlook missed, and the company is blaming supply challenges. You also, of course, have another Apple supplier. Cirrus is one. Skyworks Solutions is one. It's interesting, its outlook beat, but it is still down 8% in pre-market trading. The company reported more than 30% declines in revenue for mobile phones, and part of that is 40 to 50% declines in sales to Apple. And of course, Apple warned about the semiconductor shortage yesterday. That is why the stock gave back its early gains on the back of earnings, and once again lower by nearly a full percentage point in pre-market trading, John.
Execution risk has got to be the story of the week so far. Kaylee, I know you get your second dose of the vaccine today, so good luck.
Thank you very much.
We hope to see you on Monday in good shape.
Fingers
obviously.
crossed.
What am I talking about?
Yeah, seriously.
She's totally fine.
Like, of course she's going to be fine.
She'll be back on Monday. She'll be totally fine. Just winding Kaylee up.
You didn't say that to me.
I didn't.
You
I
were
knew
like,
you were strong.
all right, let's see you.
Wait a sec. I got a second dose. I came into work and I felt absolutely terrible. And Lisa was getting the second dose the day off when I felt absolutely terrible. And Lisa walks in and says, I'm a mother, I can take it on. And I looked at her and I was like, okay. Like, I didn't say anything. All right. And then literally 24 hours later, Lisa, how did you feel after the second dose?
Actually, during the show, I started to get the chills and I started shrinking down, and maybe John won't notice. Anyway, save me, John.
You get through it. Mark McCormick joining us now, TD Bank Global Head of FX Strategy. Mark, good to catch up, sir. I want to talk about euro dollar, the range we've been in over the last 4 months, how the story's evolved, and ultimately what you're looking for now.
Yeah, it's been an interesting story because it's one where the euro peaked basically to start the year. I think a lot of it then had to do with the outperformance of the U.S. economy, U.S. exceptionalism, U.S. opening up, the vaccine story. All those things were not in the price basically when we came through. We looked at a short euro trade in December. And what we're starting to see now is, again, quite interesting because April was a reversal of some of these themes. It was very pro-reflation. It was very good for commodities. And it was very good for the story that the Fed is still going to experiment with average inflation targeting, which means they want to keep the expansion moving longer and keep real rates at bay. So it's given the euro and other currencies some room to catch up. I think where we're at right now, 120, 121, is very interesting because it's a pivot point where, based on our forecast, we think euro is 115 to 120 rather than 120 to 125, which is generally more market consensus.
I just want to run through some concepts with you, Mark, just to add a little bit of meat to this conversation. Things like the dollar smile, which are pretty intuitive for people in the FX market. Now we have these shifting reaction functions, this shifting framework at the Fed. Does that challenge traditional concepts in foreign exchange?
I think it absolutely does. We are in a very unique cycle. I think everyone's aware of it. The structural forces that I think are really important is we're seeing less globalization. We're seeing obviously much of a pull on the political side more towards domestic agendas, domestic spending. So you take with that, you have a dollar smile where the dollar performs well when the U.S. economy is doing better than the rest of the world. And you have the dollar perform, the U.S. does well when the rest of the world is not doing well as well. I think the key thing for the euro is really going to be how do equity flows and how do central bank policy and growth policy all work together? I think a big part here for the dollar in the second half of the year is going to be how does Biden basically pay for the stimulus package, which is through higher taxes, which will come through equities. There's an element there that could push the euro higher or at least kind of keep it from stumbling too much on what is a U.S. positive growth story. But I think when we go back to the Fed, the experiments around all these things, if the Fed is going to be the central bank that lags, we're seeing it now with the Bank of Canada, with the Norges Bank, that the Fed is lagging other central banks. That's going to be very interesting to watch as a structural weak driver of the dollar, especially if equities start to, U.S. equities underperform other major economies. But the flip side is that on the dollar smile, the U.S. does have a better growth story than most other G10 countries.
Mark, let's unpack some of this, because there are three different components to FX trading that you just laid out and touched on that don't have necessarily cohesive stories. You have where is growth accelerating the most, you have interest rate policies, and then you have the debt deficit, right? And these are three different stories, and they kind of lead at different times. Which is leading now? Is it the growth story, is it the interest rate story, or is it the debt sustainability story?
It's a great question, because I think it's basically what we've called it in thematic terms very simply. It's an unsatisfying mix of global reflation and U.S. exceptionalism. Again, I think what the market got wrong at the end of last year was really extrapolating the global liquidity trade, global reflation infinity, and kind of missing what was happening on the positive side in the U.S. And now I think the market kind of stumbled again in March and April, trying to extrapolate U.S. exceptionalism as a lone theme. I think right now what we have to do is manage the fact that both of these themes are very important, and the Fed is basically driving us more towards a global reflationary environment. So I think what you need to think about in terms of styles or you know, ways of thinking about currencies is really its relative growth, its carry, its terms of trade and commodity exposure, which is huge, because you know the one thing that people are trying to figure out is inflation going higher because of supply constraints or demand. And there's an element of both, but if you look at supply, there's port strikes in Chile, which have been very important for copper. Palladium has been moving based on mining supply bottlenecks in Russia and South Africa. So there's an element here that we don't know if it's supply driven or demand driven, but the commodity terms of trade is very important when you look at the Canadian dollar, the Norwegian krone, when you think about Chile, Colombia, Russia. Some of these major currencies that have been big parts of these moves are trading off the terms of trade. So I think when we kind of go back to it, you need to kind of think about the factors. It's absolutely growth. It's absolutely carry. It's relative central bank policy. And it's going to be the commodity cycle, who wins and loses on that throughout this business cycle.
Mark, what's your highest conviction trade right now?
I think the most interesting trade in G10 is selling the Canadian dollar versus the yen. I think right now, if you look at some of our models, like what we're trying to figure out is how much good news is priced in. The Canadian dollar story is really interesting. The Bank of Canada is kind of a lone wolf right now. They are diverging from the Fed. It looks like they want to hike rates next year versus our call for a Fed hike in 2024. But what's interesting is we are moving into the sell in May. We are moving into what is very choppy trading time when we look at the Q2 seasonals. And I think what also is very interesting, if you look at the VIX, it's trading at about a 3 standard deviation discount on our top-down global macro PCA model, which is telling us that volatility should be higher. So if we get more two-way risks and essentially a weaker data story coming through Canada in May, I do think there's a lot of room for CAD yen to move lower, at least in the G10 as a top trade.
This market would love a whole lot more two-way risk. Mark is going to catch up. Mark McCormick there, TD Bank Global Head of FX Strategy. What a year it's been for crude. WTI up by more than 31%. Some numbers out of Exxon, Lisa. First quarter adjusted EPS 65 cents, the estimate 61. The company, ExxonMobil, seeing the second quarter continuing demand improvement in downstream. And then here's one for you, Lisa. Reducing the debt by over $4 billion. A couple of the headlines from Exxon this morning.
Yeah, I knew that you'd pick up on that. Just beating expectations dramatically, the biggest profit since 2019. Paying down debt, I think, is interesting because you've seen this renewed discipline. This is what people are talking about in the oil space. And this comes, of course, after the shale boom and then bust, particularly in the debt markets. You do wonder how much big oil will consolidate their share, consolidate their power as some of these shale producers continue to struggle and they really shore up their bottom lines.
A lot of money that was raised last year ultimately wasn't needed. A lot of money that was set aside through last year ultimately wasn't needed. We saw that in reserve release, Lisa, for the big banks here in America.
Yeah, although, again, it's a tale of two different types of companies. The big companies that are getting bigger and the small ones that still have a lot to pay back.
Amazon just capturing that story perfectly with last quarter's earnings. Coming up on the commodity market, Paul Sankey, Sankey Research founder and lead analyst in your equity market. We're down about 0.5%, negative 21 on the S&P. Alongside Lisa Brabitz, I'm Jonathan Ferro. Tom Keene is back on Monday. This is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. In Israel, a stampede at a Jewish religious festival earlier today killed at least 44 people and left 150 hospitalized. It's one of the deadliest civilian disasters in Israel's history. The crowd was estimated at 100,000 people, mostly ultra-Orthodox Jews. AstraZeneca will ask the U.S. for emergency authorization of its coronavirus vaccine. That's after it missed an original target that raised questions over whether the company would apply for the clearance at all. U.S. citizens may not see the Astra vaccine in clinics in the near term. The U.S. has announced it would share its entire supply of the vaccine with other countries. In Florida, Republicans in the legislature have voted to impose a number of restrictions on voting. That adds to the national push by Republican lawmakers to make it more difficult to vote. Florida has been a crucial battleground state. Donald Trump won the state by more than 3 percentage points in November. And Nestle is expanding. In a segment, the company entered under the 5-year watch of CEO Mark Schneider. It's agreed to buy vitamin maker Bountiful for a little under $5.8 billion. KKR has been planning an IPO valuing Bountiful at more than $6 billion. The Nestle deal means that there won't be a public offering. And HSBC is becoming the latest global bank to address burnout amongst its staff. According to a memo seen by Bloomberg, HSBC's global banking unit will raise fixed pay for junior investment bankers in key hubs and hire more of them to share the workload. The British bank also will shorten the time needed for some associates to become vice presidents. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Rishka Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kayleigh Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
pretty excited about having good exposure to copper at that time when the world's going through the energy transition. I think copper's got a pretty good story in front of it. I think its day in the sun is more towards the end of this decade when we've got some nice exposure to it.
I'd be pretty happy with exposure to copper right now too. That was Tom Palmer, the Newmont CEO and president, on copper and a future as well. From New York City this morning, good morning. Alongside Lisa Bravitz, I'm Jonathan Ferro. Tom Keane, a long weekend. He'll be back with us on Monday. Your bond market yields higher by a basis point on a 10-year to 164.37. In the equity market, positive, then negative, down 21 on the S&P 500, up on a week, up big time on a month, down on the day by about 0.5%. Euro dollar 120.85 and down 1/3%. A negative GDP print against a much, much better US read. Relatively speaking, a story obvious through Q1. How do those stories converge in the months and quarters ahead? And finally, in the commodity market, 63.74 on WTI, down by 1.95% on the WTI contract. Crude on the year, up 31.47%, Lisa. And this line from Goldman earlier in the week, we see commodities rallying another 13.5% over the next 6 months, at the time of publication, of course, with oil reaching $80 a barrel and copper reaching 11K with risks to the upside.
It's dramatic, and you think about how this super cycle will be different than previous super cycles because it's not being led by China. But I will raise this, and this goes to the whole idea of disinflationary tilts. There was a story on the Bloomberg today that copper, the fact that it's risen so much, industrial producers in China are starting to cut back on their use of it, which raises a question. How much is this supply-demand dynamic going to shift in people actually buying less of these commodities because of their high sticker price?
Let's turn to Paul Sankey on this. Sankey Research founder and lead analyst. And Paul, we've got to do a couple of things. We'll start with the commodity story, and then we'll go to the companies with exposure to them. Can we just start with that Goldman call? 80 on crude maybe over the next 6 months, this huge demand shock that's set to come through the rest of this year. Paul, what was your take on that?
Well, we like the call as, you know, a core business of ours is covering oil. So it's interesting. We do agree that the demand side, obviously, seasonally is going to go up a lot. The Goldman numbers, as you know, are very big. You know, they're talking about sort of 6 million barrels a day of incremental demand growth over the coming months, which, you know, gives you rise to this this sort of $80 price forecast. They weren't specific about the dollar. You know, for me, the dollar is always very important. And what we've seen here, as you know, is the dollar has held up pretty well, just as the T-bill, you know, has actually rallied. And the question then becomes, if those two start acting to support oil, push oil higher, which would be a weaker dollar and higher interest rates, we could easily get to 80, easily.
Well, Lisa, let's talk about the T-bill. Front end of the yield curve, very front end of the yield curve. What did we get? 0.
That was the first time that it got 0, right? The U.S. can borrow money for free, John, going back to the height of the pandemic. And actually, if you look at where things are trading, negative yields. And Paul, this raises a question going forward of how much this money is going to fuel demand, is going to fuel some of the dynamics that will lead to at least $80 a barrel, as you say. I mean, do you see people continuing to consume even in the face of higher commodity prices?
Well, you know, on U.S. gasoline, there's an S-curve. So there's a wide range of prices through which people really don't change behavior. And we're a long way from people actually changing behavior because of the high prices. You are getting anecdotally people saying, I noticed gas prices are higher, but they actually don't change their behavior, which they're very capable of doing. For example, typically you have 2 cars in a household, you use the more efficient car. My favorite was in 2008 when prices got super high for gasoline. When PetSmart, I think it was, or one of the pet, maybe it was PetStop, one of the pet companies said, we're the last shopping trip of the week. And because gasoline prices are so high, unfortunately, people are not going to the pet store. So to give you an idea, there could be some elasticity of demand later. We're also worried about India, obviously, because India is very price sensitive and also has obviously the COVID problems. But in the past, you've seen that China is price inelastic for demand, which was what was interesting about your copper comment, which is to say, essentially, it's sort of a central decision as to whether to use or not to use. And in the past, we've seen China really use a lot of oil at high prices regardless. So when you add all of that together, you're in a situation, I think, where demand will continue, as Goldman has said, will continue to rip, just because we've been in a COVID situation, which is not a price elastic situation. That is to say, it didn't matter how cheap gasoline was, people weren't going to drive. Now what we'll see is because of the scale of economic activity that's being pumped by the Fed, I think you'll see pricing elastic demand for oil, which is to say will drive gasoline prices very high this summer.
Right, so that's the demand side of things. The supply side, though, more of a question. You do wonder how much the discipline of OPEC Plus, the discipline of shale producers, will sustain itself in the face of 60, 70, 80 barrels a dollar, $80 a barrel. I mean, what do you view in terms of supply to meet the demand?
Well, I had a good meeting with the CEO of Devon, for example, the other day, where they get it. You know, they realize that this industry has got a bad reputation for spending more during high prices. One of the rollouts that they've had over the improvement of strategy that we've seen over the past year or so has been, they say, oh, we're only going to spend 70% of cash flow on CapEx. And the market's kicking back. We're kicking back on that. We're like, that's not good enough, because that means you spend more at higher prices. We want fixed levels of CapEx, and we want all the free cash flow to come back to shareholders to make this sector truly attractive. The worry is that private equity will pile in anyway, but of course you've seen a significant reduction in financing for oil and gas for various reasons that you're aware of, such as ESG. And so it's become a much tighter financed industry with a much higher cost of capital. That's why people like BP and Shell talking about investing in ESG are kind of misguided, because their cost of capital is so high. They shouldn't be competing with the companies that are designated renewable investment companies that have zero effective cost of capital. And that's a big mistake those companies are making. So we've seen very negative relative to cash flows reaction to BP and Shell results this week. Really quite staggeringly negative.
Interesting.
Actually, think about how much money they made.
Paul, I want to jump in because we've only got about a minute left. And I want to make sure we fit this in. Just from what you're saying, is that leading to specific calls, stock selection for you right now?
Well, I mentioned Devon. I mean, we love that one. I think that's a great company in terms of leverage, and they get the memo on this capital discipline plus cash return. And across the board, the E&P industry is just much, much better. And on top of that, then we have good refining and good chemicals. So the oils in general look good here, especially if you're looking for inflation and higher interest rates for the Treasury.
Paul, it's good to catch up. It's good to see you.
Thanks,
Paul Sankey, Sankey Research founder, lead analyst. Paul, thank you. Exxon with some decent numbers again, Lisa. The stock down by about 0.4% in the pre-market. Crude doing okay, a little bit lower this morning, but up 31.47% year to date, so not bad.
Yeah, really interesting to me, because not only did Exxon post good earnings, they posted the first profit since 2019 and rose their dividend. This idea here that they are shielding their third largest dividend, or they generate enough cash to cover it. Again, stocks as bonds, John. When are people going to start to play that? Or is some of the reluctance to buy big oil simply a question of ESG parameters and things of that nature keeping people away?
A question for Joe Quinlan, maybe. Maryland Bank of America Private Bank head of CIO Market Strategy. He'll be joining us shortly on this program. Long title, that one. We'll talk to him about that.
Oh, yeah? What are you going to short it to?
Just CIO of something.
Put money in stuff.
You know, something.
Buy things. Go cash.
I don't know, Lisa. It's just too long for me to read. Down 21 on the S&P. We're down 0.5%. I'm a simple man without a title. Yields up a basis point, 164.54. Alongside Lisa Bramvitz, I'm Jonathan Ferro. Tom Keane back with us on Monday. This is Bloomberg.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and deaths. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen. Well, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, the party, makeup will bounce back.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
The only real surprise for me this earnings season so far is the magnitude of the beats.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change?
Whether you're growing at 9% or whether you're growing at 6%, let's face it, the labor market, I think, is going to remain very strong for at least the next few quarters.
I think we're in the third inning of a continuous economic cycle that will continue to bear fruit. So I don't think this is sort of peak growth.
Where does this thing peak out? I have no clue. The companies don't have a clue.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Getting you to the weekend from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene back with us on Monday. Your equity market, slight declines on the S&P 500, pulling back from all-time highs. We spent this morning, the week, talking about big beats. And the big beats, Lisa, continue.
Yeah, although I do wonder whether the rest of the people on Wall Street have the same attitude that you do, which is just getting to the weekend. It is the weekend, and I know that that's how you started every Friday, but I do wonder if that's the feeling, if there is a level of exhaustion, especially with the magnitude of beats and just the shrug, the fact that we're just sort of range-bound here, given the incredible numbers that we've seen posted, particularly out of big tech.
We saw this in the bond market, though, a couple of weeks ago. We had a higher-than-expected CPI print, bond market rallied. Higher-than-expected retail sales print, bond market rallied. Now we're seeing it in the equity market. Big earnings from the big players, the big weightings on the S&P 500. No big moves.
There is a question, though, embedded in some of the price action for this month, and we are coming to the month end of April, which is, has the cyclical trade faded? Has this idea of the rotation into small cap stocks really faded, or is this just a pause, a reset as people recalibrate ahead of a true reopening? We can see that the Russell 2000 up less than 2% so far this month versus a nearly 5% gain, as you've been talking about on the S&P 500.
So I would say the simple trade has faded. Now, what I mean by that, and I get really frustrated when people talk about the easy money has been made. I don't think you ever make easy money in a market, but I think you can make very simple money from simple approaches. And what I mean by that is when you think there's going to be a cyclical upswing, buy the cyclicals, buy the sector, factor investing. This time around, Lisa, I think things are way more nuanced. If you look within sectors right now, let's talk about ad spend.
Yeah.
Great at Amazon, great at Facebook, bad at Twitter. Elsewhere, What did we have? Huge pull forward last year. Was the payback? Not at Amazon, didn't see that, but certainly saw it at Pinterest and maybe saw it at Netflix too. Execution risk, some companies are really struggling with that, other companies aren't. It's getting way more nuanced, so maybe the simple part of this cyclical trade has faded.
Would you say idiosyncratic? Or
I don't know about that. I think execution. I prefer the word execution.
Do you think that I should be the official correspondent for the right-hand podium on surveillance?
You can be. What does that mean?
I'm just trying to come up with a good title.
For your podium?
Yes, do you think? Think it works or not so much?
I think it would get pretty confusing.
All right,
as
how
the
about
weeks
that
progress.
price action?
I'm going to do that. I think I know where you're going. I'm going to get there in a second. Your equity market down 21 on the S&P 500, pulling back from all-time highs, pulling back from record highs on the S&P 500. I know we're talking about a market that hasn't responded to better numbers. When we're doing that, we're talking about Apple not responding. Alphabet did. We're talking about Amazon not responding in a big way. Other companies have. But for the broader market this week, it's been a slight lift. The S&P 500, 41.82. Over the month, though, it's been a really decent month of gains, up by more than 6% coming into Friday's session. In yields, up about a basis point, a 10-year to 164.19. In the FX market, euro dollar 120.82. And now I'll turn to what I think Lisa is getting at, which is confusing titles. I don't have one. Joe Quinlan does. Maryland Bank of America Private Bank Head of CIO Market Strategy. I got that out all at once, Joe. You'll be proud of me. Let's talk about this market and how we're responding to data points. The bond market rallied on good data. This equity market's not had a big lift this week on great earnings. What do you take away from that, Joe?
I take away, John and Lisa, what you were talking about, a little bit baked into the cake, so we've got to really, we're up, S&P's up, say, around 12% year to date. So some of these companies really knocked the ball out of the park, but they kind of hanging in there, like at Apple, like you talked about. Others goes back to that execution. So I really think that the bias is upwards, but we get these pauses. We've not seen in the S&P 500 a 5% pullback or more in over 6 months. So it's quite remarkable in that sense. Typically they come and go, you reset. So I think the numbers are coming in better than expected. It's execution, and then we roll in this, and I think more cyclicals and materials, and that story continues to play out.
We're resetting. We're resetting on the south side as well, Joe. Just want to bring you some numbers. When we came into 2021, 2 banks had price targets. 2 banks that I can think of had price targets north of where we are now. JP Morgan was at 4,400. Goldman Sachs was at 43. Jonathan Golub at Credit Suisse has just upgraded from 43 to 4,600 on the S&P 500. That's the price target boost on the S&P from Jonathan Golub and the Credit Suisse team this morning. So, Joe, I asked a simple question this morning. When you look at the data this week, I think we all understand the response so far in the equity market, but for you on how it sets us up for the year ahead, does it validate current valuations or justify further gains?
I think it does justify further gains because everything is happening at warp speed. The decline that we saw a year ago coming out of the hole, companies executing, moving remotely, and also overlay just the big government spending. I think that kind of has blown a lot of people away, that how much we're spending, and it's working. It's backstopping small businesses, households. So I do think this economy is very resilient, and now it's working with the private sector and the public sector. So when you put those two together, feels to me like a mixed economy. And I'm a free market guy, but a mixed economy, that's going to be a significant lift to growth in these new industries, whether it's 5G, renewable energies. That's where we're going, and I think that's what the market is sensing.
I got to say, John, Tom Keene has gotten into my head so much, John.
That's not good.
I know that
What's
as Joe is talking about, 5%, we haven't seen a 5% pullback in the past 6 months. I think go to cash, go to cash, go to cash. Anyway, I will say, Joe, there is a question going forward. You're talking about big spending. How much of these big spending plans have actually been priced in? In other words, how much of the $4 trillion in fiscal support that Joe Biden has put out there in social programs have actually been accounted for in stock markets?
Lisa, I think there's more to come in terms of the price appreciation because, as you know, a lot of this money hasn't even been transferred yet. It's out there, so it's construction, the materials, someone that's building, the big Caterpillar type companies. So, but the key is, how quickly, how does it, filter down? And these are multi-year plans, right? These are multi-year investment plans. So if you're an investor, don't chase these stocks right now. There'll be pullbacks, execution. We've got bottleneck shortages. So I think the cyclical play is still on, but maybe later this year on a pullback, you can buy them cheaper.
Joe, just going to cut in with a little bit more detail from the team at Credit Suisse on this upgrade on the S&P 500. We are raising our 2021 S&P 500 price target of 4,600 from 4,300, representing 9.2% upside from current levels and 22.5% for the year. Couple of bullet points, Lisa. Red-hot economy fueling earnings, strongest revisions and surprises ever.
22% for the year. Joe, the idea of a double-digit year, yet another one after people thought, oh, it's going to be mid to upper single digits. How long can we continue with this? I mean, basically, this would be the third consecutive double-digit return for the S&P 500.
Well, Lisa, it's a good point because I think Jonathan's pulling forward some of that earnings that we might have saw in 22. So he's pulling forward some of those earnings. And so, to Lisa, to your question, I think, 22, when we kind of look at, say, year-over-year, quarter-over-quarter comps, it's going to normalize. We're going to go back to single digits, stock picking. So I think some of the analysts raising their estimates for this year, pulling forward from next year on the good news, how much spending, the optimism, vaccinations, you name it.
And starting to price maybe a higher tax rate as well. There's a note here from the team over at Credit Suisse, Joe. Our 2022 EPS assumes an increase in the statutory tax rate from 21 to 25%, a 4 to 5% hit to earnings. Joe, are you starting to think about that too, the year ahead and what taxes could mean for earnings?
Well, we look carefully at that, John, and if we go 21 to 28, we can live with that. I think the markets can make up for that, particularly the multinationals. They've got the scale. They can work with their margins. So I don't think it's a rally killer, but it's certainly going to shave off 22 estimates. And it makes, so you could see some selling pressure going into the year end. But at the end of the day, companies can handle this. If you told me we're going back to 35%, the street would be awake and marking down estimates.
Joe, it's good to catch up. And to get your response to that note too. Joe Quinlan there, Maryland Bank of America Private Bank Head of CIO Market Strategy. I got that out as well. 2021 EPS, $200, previously $185. This is Credit Suisse. 2022 EPS, $215, previously $210. So there's a slight upgrade to earnings in 22 here for the team at Credit Suisse that includes a tax haircut. The S&P 500 year-end target over at Credit Suisse now 4,600 from 43. And just to repeat and reiterate, re-emphasize what we were talking about moments ago, Lisa, it implies another 9.2% upside from where we are at the moment in this market.
Yeah, when are we going to get the idea that we're bringing forward some of the returns? We keep bringing forward returns, and we bring them for the next 20 years. I do want to just go back to this idea of higher taxes being baked into Credit Suisse's view here. I am really trying to understand what tax rate we're actually looking at, because the headline tax rate and the real tax rate for corporations is very different. I'm just going to throw this out. The top 20 companies, and this was data that was highlighted by Bloomberg Economics, paid a median effective tax rate of 17% last year from 35% in 1990. That is the effective tax rate after you already account for all of the loopholes and the other ways to get out of things. So what tax rate exactly, John, are we talking about?
I don't know. Depends what it comes in at, doesn't it? And the effective tax rate, I mean, let's be honest, if the actual tax rate comes up, Lisa, the effective tax rate will come up, not necessarily to the number, but you've got to bake that in.
Although Bloomberg Economics was taking a look at that after Trump cut the taxes, their tax rate didn't go down all that much because they already were so much lower than the headline number. So it's very difficult to parse this out, which is the reason why I sound like a broken record when I keep saying, why isn't there more of a discussion around actually having a tax rate that coheres with reality?
No, Lisa, I totally agree with you. And I don't think it's as simple as reverse engineering what happened last time around. I've talked to a lot of analysts about that too. They're all grappling with the same thing. Just to add a little bit more clarity, some color to this call, consensus GDP forecast call for 6.3% real growth in 21, 8.6% nominal, the fastest pace in nearly 4 decades. Here's a nice little tidbit for you, a stat, Lisa. Every 1% improvement in nominal GDP translates to a 2.5 to 3% gain in S&P 500 500
Go to cash. I just keep hearing it over and over again.
How's that worked out?
Yeah, exactly.
I wonder if he's listening today. Equities pulling back from all-time highs. Jonathan Golliver, Credit Suisse, now looking for 4,600 on the S&P 500 year-end, an upgrade from 43, right now 41.83. From New York City, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. By September or October, President Biden is likely to see some version of his $4 trillion economic plan passed in Congress. The president has 2 major tasks. He has to keep various Democratic fractions from splintering the party and he has to keep fending off Republican attempts to portray the plan as radical. Democrats can use Senate rules to bypass Republican opposition to most of the plan. And more fallout from the latest tensions between the U.S. and Russia. The U.S. Embassy in Moscow says it will slash visa and consular services following a Russian ban on hiring local staff. The embassy says services will reduce to a minimum. Russia imposed the new limits after the U.S. announced new sanctions and expelled 10 Russian diplomats. The euro area economy slid into a double-dip recession at the start of the year. Strict coronavirus lockdowns kept businesses closed and consumers were reluctant to spend. Output in the 19-nation euro area was down 0.6% in the first quarter. It fell nearly 3 times that rate in Germany. Meanwhile, the U.S. posted annualized growth of 6.4%. ExxonMobil rebounded to its first quarterly profit since 2019. Rising oil and gas prices should help restore investor faith. It can cover the third largest dividend in the S&P 500. Meanwhile, Chevron generated the most free cash flow since the pandemic, $3.4 billion. That was enough to cover its recently raised dividend, but Chevron's refining division earned just $5 million versus more than $1 billion a year ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
right now you can get $400 extra a week, and that's going to go through September. Are they going to not take that job or not? Some people are going to make that calculus and they're going to say, I'm not going to take the job, okay? But I don't buy the argument that everyone's sitting out of the labor force just to collect $400 extra a week.
That was Jay Bryson there, the Wells Fargo chief economist from New York City this morning. Good morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene back with us on Monday. Here's the price action of the moment this Friday morning, shaping up as follows. A taste of flavour of an equity market that's been ripping towards all-time highs over the last 6 months. We pull back, down 21 on the S&P and down 0.5%. The call of the morning, Jonathan Golliber, Credit Suisse and a team, 4,600 on the S&P 500, boosting their price target from 4,300. And Lisa, I keep going back over the numbers. Another 9.2% upside, the call from current levels for the team at Credit Suisse.
22% gain in the S&P 500. That would be the implication here. I'm just thinking about how people thought that 2020 was peak year for markets, given the fire hose of cash from the Fed and the fire hose of cash from the federal government. It seems like that fire hose is continuing and then actually accelerating with that $4.1 trillion plan by Joe Biden. Question is, how much will actually get into the market?
Yeah, and they've upgraded their earnings forecast for next year too. 2022 EPS 215, previously 210, including a tax haircut. To Lisa's point, though, I think this is what we're all grappling with right now, going into the year ahead. The start of negotiations. Where does it end up? Let's bring in Michael Zezas, Morgan Stanley, head of U.S. Public Policy Research and Municipal Credit Strategy as well. Michael, can we start there? The numbers that you come up with at Morgan Stanley and how on earth you come up with them?
Yeah, fair enough. So as you mentioned, you've got about $4 trillion of planned spending over a 10-year time frame. And all we simply do is when we break down the components of that, we try and count the votes that are out there in the Senate and the House of Representatives to support it. And in short, I think almost all of that spending is pretty viable. It's really the taxes that we think aren't viable, at least all of the taxes. So by our estimate, there's probably only about $1.8 trillion or so of tax increases that are viable, including some corporate taxes, some personal income taxes. So you're left with the deficit, which we actually don't think is particularly problematic or is probably what's ultimately going to bridge the gap here. So ultimately, I think next year you'd be looking at a year one deficit hit of around $500 billion. That continues the fiscal expansion that we've had, continues to underwrite the V-shaped economic recovery and increase in net aggregate demand in the economy, at least coming from the federal government.
So there's a question of whether the debt is worth it, right? I mean, all debt is not equal. If we do increase our deficit, but we're spending money on programs that really generate economic growth, this is viewed as paying for itself on some levels, or at least starting to pay for itself. How much does this plan generate the economic growth to justify the price tag, to justify the increase in debt?
Yeah, and listen, the administration is obviously taking this angle as well. I think one important thing to note is that these plans are presented as paid for in part because the administration is assuming that the taxes will continue over a 15-year period, that the spending all happens within an 8-year period, right? So that there is some payback effect from economic growth of that spending in early years. I think the way to think about it is obviously, one, if you're spending more than you're taking in terms of the GDP equation, that's net additive, at least in the short term. But then two, the way our economists think about it is that if the money is being put to infrastructure and is sort of being downstream to lower and middle income cohorts, that's a higher marginal propensity to consume. At the same time, the taxes are taking money away from lower marginal propensity to consume cohorts. All of that should be net additive to GDP.
Which raises a question about how to pay for this and whether foreign investors will see this and actually go into the dollar or whether they will withdraw from the dollar, thinking that inflation is going to pick up, because if you have people with a higher propensity of spending and they're spending more, that definitely is a recipe for inflation. How concerned are you about borrowing costs increasing materially without the Fed expanding its balance sheet ad infinitum?
Yeah, well, I think the way to think about it is inflation is the pay for at the end of the day. Deficit expansion to bridge the gap between what Democrats can raise in terms of taxes versus spend, that effectively translates to higher inflation pressure. So I think the next big question for markets then is, how is the U.S. going to deal with that inflation pressure? What is the Fed's reaction function? ultimately, our economists think that over the next 12 to 18 months, there's enough economic slack right now that you're not going to see this translate into the types of inflation pressure that, beyond a further bear steepening of the yield curve and some modest margin pressure that can maybe move the equity market sideways, that this isn't a particularly problematic fiscal effort. However, we have to watch that closely and watch the Fed's reaction function, because if there's some notion that the Fed's becoming more permissive on inflation than they previously had, or that they've already signaled via, for example, their average inflation targeting plan, then you could see quite a bit more volatility.
Michael, you wear two hats. You run public policy and the research over at Morgan Stanley. You also look over municipal credit research as well. I just wonder how you're tying those stories together right now.
Well, I think the easiest tie is that the federal government really came in through the last few fiscal packages and downstreamed a lot of aid to municipal governments, frankly, more than we think they needed to hit their prior revenue baseline. So you've gone from a situation where if we were having this conversation a year ago, we'd be talking about how distressed the municipal credit market was, to one where effectively the arrow was pointed upward on credit fundamentals in almost every single sector. So the federal government's really been quite supportive of that market. And now the sharp economic recovery is probably going to take the handoff from there and continue to create a lot of fundamental health there.
So you don't think that's fully priced? Forgive me for asking the lazy question, but do you not think that story's fully priced yet?
Municipal market, I do think it's fully priced. Yeah, I do think it's fully priced. I don't think there's a lot of scope for relative outperformance in that market from here, right? So I think if you're owning a municipal bond at the moment, you can feel pretty good about the credit fundamentals. But the reason you should be owning it isn't probably for outperformance versus treasuries or outperformance versus corporates, right? It's for asset allocation, it's for owning duration, a very different mindset. If you're looking to outperform an aggregate benchmark, for example, buying tax-exempt bonds, I don't think that's the right way to go.
What's the right way to go, Michael?
Well, is that frankly we prefer owning corporate credit at the moment.
I was looking for him to say Puerto Rico.
Well, he didn't say that. Michael, we'll let you go. We'll let you run. It's good to catch up.
Right.
Michael Caesars, Morgan Stanley, head of U.S. Public Policy Research and Municipal Credit Strategy. If he says it's not the right way to go, I've got to ask what is the right way to go, and corporate credit still for some people out there, Lisa.
It depends where, though, in corporate credit, right? Because you've got the same kind of story at the upper ends of the rating scale, where you have very, very low spreads, very, very low extra yield to over benchmark rates, and rates that a lot of people think are going to go up, especially if Michael Zezas is right about inflation.
Yeah, and how disruptive will that be? Coming up on the program, Afsan Ebeshlos, the Rock Creek Group founder and CEO, in your equity market, pulling back a little bit from all-time highs on the S&P 500, down 19. We declined 0.45%. In just a moment, PCE, personal income and spending data, going into that, yields unchanged on a 10-year at 163.83, and the FX market 120.84 on euro dollar, and crude down a little more than 2%, negative 2.37% on crude. WTI $63 and about 47 cents. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene back with us on Monday on radio, on TV. This is Bloomberg Surveillance.